All right, let's just get right into it. Welcome to today's Explainer, where we are going to completely demystify the world of investing. Listen, if you have ever felt like investing is just this totally foreign language meant only for Wall Street pros, believe me, you are not alone. It can feel incredibly intimidating. But today, we're going to turn all that fear into a concrete, completely jargon-free action plan. By the time we wrap up here, you are going to know exactly how to go from absolute zero to making your very first investment. So picture this. Imagine you've got an extra $1,000 sitting around right now. What's the plan? You basically have a few options, and honestly, most of them are kind of terrible. I mean, you could spend it on something fun, sure. You could stash it under your mattress, or you could just let it sit in a basic savings account. But here's the thing. Doing nothing with that cash actually introduces a massive, silent problem to your financial life. And this perfectly illustrates that hidden danger, inflation. Think about your absolute favorite caramel frappuccino. A few years ago, it probably cost you, what, $5? Today, you're looking at $8 or $9 for the exact same drink. That right there is inflation in action. Prices go up, and your money's buying power literally shrinks. If your $1,000 is just sitting there doing nothing, it is actually losing value every single day. The absolute smartest move you can make is to invest that cash so it grows instead of shrinking. To help you do exactly that, here is our roadmap for today. We're going to cover 1. Why you must invest. 2. What to actually buy. 3. The pre-investing checklist. 4. Opening your first account. And 5. The long-term mindset. All right, Section 1, Why you must invest. We're looking at the hidden danger of inflation versus compound interest. The absolutely crucial thing to understand right out of the gate is that growing your wealth isn't magic. It's just math. Math that relies heavily on what Albert Einstein famously called the eighth wonder of the world, compound interest. Think of compound interest like a giant snowball rolling down a hill. As it rolls, it packs on more and more snow, getting exponentially bigger and faster. For example, if you invest $1,000 a month with a 10% return, after about 6 years, you'll hit around $100,000. But here's the crazy part. The next $100,000 takes less than 4 years. The one after that, less than 3. By the time you hit $1 million, your portfolio is growing by $100,000 or more every single year. That is exactly why starting early is everything. Moving right along to Section 2, What to actually buy. We are debunking stock picking and fully embracing index funds. Now that you're fired up to start, we really need to talk about where your money is actually going. And I have to warn you against a wildly dangerous mistake that so many beginners make: chasing hot stocks. Look, just because a stock crushed it last year absolutely does not mean it's going to do the same this year. Take Kodak. A few years back, they peaked at around $90 a share, but when it crashed, it plummeted all the way down to a single dollar. If you bought in just based on past hype, you literally lost almost everything. The better, safer, and honestly way less stressful move? Index funds. They give you long-term, diversified growth without the total heart-stopping panic of watching one single company collapse. Jack Bogle, the legendary founder of Vanguard, hit the nail on the head here. He said, "Don't look for the needle in the haystack. Just buy the entire haystack." An index fund gives you exposure to the entire market all at once. Even Warren Buffett says that pretty much everyone should just be investing in index funds. And hey, if it's good enough for Warren Buffett, it's for sure good enough for us, right? So let's quickly unpack that jargon. What exactly is an index fund? Well, an index is simply a list of companies, like the S&P 500, which is literally just a list of the top 500 US companies. Think Apple, Microsoft, Tesla, all the big ones. A fund is just a giant pool of money collected from everyday investors like you and me used to buy those assets. When you buy an index fund, you're essentially taking your eggs and putting tiny, tiny pieces of them into hundreds of different baskets. So if one company completely tanks, it barely even registers for you because you have hundreds of other successful companies carrying the weight. It drastically lowers your risk. Okay, but before you hit buy on any fund, you have got to check the expense ratio. This is basically the fee that covers the administrative costs of running the fund. Let's say a fund charges a 1% expense ratio and you invest $11,000. That means you'd automatically be paying $110 every year in fees, pulled directly out of your investment. You want to keep these fees as low as humanly possible so they don't eat away at your hard-earned profits over time.
So here is your rapid-fire, highly actionable checklist for picking an ETF. And an ETF, by the way, is an exchange-traded fund, basically just a type of index fund that's super easy to buy and sell. First, make sure it tracks a major index, like the S&P 500 or the NASDAQ 100. Second, confirm the share price actually fits your budget. And third, find an expense ratio that is below 0.5%. Some super popular examples that track the market are SPLG, QQQ, or SPY. Historically, over the long haul, tracking the S&P 500 delivers an average annual return of about 7 to 12%.
Which brings us to Section 3, the pre-investing checklist. These are the ground rules you need to follow to secure your financial safety net.
Hold up. Before you drop a single dime into the market, we need to make certain your financial foundation is totally bulletproof. You really need to pass this two-step test first. Step 1. Pay off any high-interest debt that's over that 7 to 12% mark. Think of a 25% interest rate on a credit card. Actually, scratch that. It's not just a rate, it's a massive hole in your gas tank. Remember, the stock market averages around a 10% return. If you are paying 25% in credit card interest, investing is mathematically pointless until that debt is gone. Paying off that high-interest debt is literally like locking in a guaranteed 25% return. Step 2. Build a 3 to 6 month emergency fund. If your car breaks down or, heaven forbid, you lose your job, you need cash on hand right then and there. Without it, you're going to be forced to sell your investments at the absolute worst possible time just to make rent.
All right, Section 4. Opening your first account. Going from absolute zero to your very first actual trade.
Okay, so the bad debt is completely gone and your emergency fund is packed and ready. Now let's get you actively investing. Where does this money actually go? You generally have two main choices for where your investments live. A taxable brokerage account gives you total, unlimited freedom. You can put in as much money as you want and pull it out whenever you want. The downside? You will pay taxes on your gains. On the flip side, a Roth IRA offers some massive tax advantages. Your money grows and you can pull it out entirely tax-free and penalty-free once you hit age 59 and a half. The catch there is that you have strict contribution limits, and you'll get hit with penalties if you pull those earnings out early. So just choose the vehicle that makes the most sense for your personal timeline.
Once you pick an account type on a highly trusted platform, think Fidelity, Schwab, Vanguard, places like that, the actual buying process takes maybe 5 minutes. Seriously. Step 1, open the account by filling out some basic info. Step 2, link your checking account and transfer the cash over. Step 3, use their search bar to find a ticker symbol. Let's say you're looking for SCHD. Just type it right in. Step 4, enter how many shares you want to buy, set it as a simple market order, and hit buy. Boom, that's it. You are officially an investor. It really is that simple.
Finally, Section 5. The long-term mindset. How to survive the inevitable volatility and avoid panic selling.
I really need you to focus here, because this final concept is arguably the most important part of this entire explainer. Investing is deeply, deeply psychological. Let's look at the historical timeline of the SPY ETF. Imagine you bought in right at the peak in October 2007 at $154 a share. Almost immediately after, the 2008 financial crisis hits and the entire market crashes down to 73 bucks. It is utterly terrifying to open your app and see that much red on your screen. The totally natural human reaction is to panic and sell everything. But remember, you only actually lose money if you sell. If you just took a deep breath and held on, by February 2013, you completely broke even. By 2018, your money had doubled to $300. And today, that exact same share is sitting around $500 to $600. That's almost a 4x return. The stock market heavily rewards patience, and it brutally punishes panic.
And if you need the mathematical proof of why you just need to leave your investments alone, check this out. Studies consistently show that if you try to time the market, jumping in and out to magically avoid the drops, you inevitably miss the big surges upwards. Missing just the 10 best days in the market over a couple of decades can cut your overall returns by over half. Think about that. An investment that could have easily grown to over $200,000 might only reach $144,000 simply because you were sitting in cash on those 10 crucial days. Time in the market absolutely always beats timing the market. So I want to leave you with one final provocative question. The market goes up and the market goes down. That is an undeniable fact. But when the next big market crash hits, and believe me, it will hit, will you let fear take the wheel, panic, and sell your assets? Or will you trust the long-term math, tune out all the noise, and just let your wealth quietly compound over time? The choice is entirely yours. Start with that checklist, grab a solid index fund, and let the math do the heavy lifting for you. Thanks so much for joining me on this explainer, and hey,